Imagine an airline that plummeted to the brink of collapse, weighed down by billions in debt, staring bankruptcy in the face and facing a future nobody dared to predict. Now imagine that same airline not just surviving, but soaring back into the sky with a plan, a vision, and a determination that shocks the industry. This is the story of Spirit Airlines, a company written off, counted out, and yet, in one of the most audacious comebacks of our time, they're rewriting the rules of what it means to rise from the ashes. Buckle up, because what you're about to see isn't just a recovery. It's a masterclass in resilience, strategy, and raw, unrelenting ambition. When you talk about Spirit Airlines' strategic financial reorganization, you're not just recounting something dry from a balance sheet. You're telling the story of a company that looked its own failure in the eye and re-engineered its DNA to survive. In late 2024 and early 2025, Spirit didn't just file for Chapter 11 bankruptcy protection. It engineered a comprehensive and supermajority-supported restructuring plan that fundamentally altered its financial foundation. The United States Bankruptcy Court for the Southern District of New York confirmed Spirit's reorganization blueprint, a plan overwhelmingly endorsed by the airline's loyalty and convertible bondholders, a clear signal that even in distress, the market saw value and future potential in Spirit's business. At the heart of this strategic overhaul was an audacious decision to deleverage the airline's debt burden on a scale rarely seen in the volatile aviation industry. Spirit converted approximately $795 million of funded debt into equity, dramatically lowering the weight of obligations that had long constrained its operational agility. This wasn't a superficial adjustment. This was a sweeping recalibration of the company's capital structure, giving it the breathing room to think beyond quarterly survival and focus on long-term competitiveness. Alongside that deleveraging, Spirit secured a $350 million equity infusion from existing investors, a vote of confidence that said, in effect, we believe in this airline's future. This wasn't money thrown at a sinking ship. It was capital committed to transformation, to enhanced customer experience, to redefined value propositions in the sky, and to strategic initiatives that could finally break Spirit out of the cycle of losses. The result of these moves was significant. Spirit Airlines emerged from Chapter 11 with materially less debt, stronger financial flexibility, and a more resilient balance sheet. The company's leadership framed it as a powerful shift, not merely surviving bankruptcy, but emerging better positioned to invest in customers and deliver value while working toward profitability. In practical terms, this measured reduction of structural liabilities and the reinforcement of capital reserves afforded Spirit options it simply lacked before, bringing real, tangible stability to a business that had been buffeted relentlessly by high operating costs, weak travel demand, and competitive pressures. This strategic reorganization matters because it illustrates how a company in crisis can realign priorities, manage creditor relationships, and leverage legal and financial tools to build a runway toward future success. Spirit didn't paper over its problems. It confronted them head-on through a restructuring plan that both reduced risk and reset expectations for stakeholders. That's not just financial housekeeping, that's strategic mastery. In the end, Spirit's reorganization wasn't an exercise in survival alone. It was a deliberate, well-structured repositioning, laying the groundwork for renewed growth and reinforcing the principle that a company's financial architecture can, and sometimes must, be reinvented to unlock lasting value. When you talk about Spirit Airlines' credit rating and financial credibility after bankruptcy, you're not just talking about a letter on a page. You're talking about the market's verdict on a company's ability to weather adversity and sustain itself going forward. In March 2025, Spirit Airlines emerged from Chapter 11 protection with a dramatically altered capital structure, and soon after, major credit rating agencies responded. One of the most notable was S&P Global Ratings, upgrading Spirit's long-term credit rating to CCC+ from D, a substantial move that reflected the company's reduced debt load and improved liquidity prospects after its financial restructuring. Let's be clear, going from a D rating to CCC+ isn't just a footnote. A D rating implies default or imminent default risk. A CCC+ rating, while still speculative, signals that the company has taken concrete steps to improve its balance sheet and that it might be able to meet its financial obligations, albeit still with significant risk. Simply put, the market noticed that Spirit had taken substantive steps to clean up its finances, and that gets a lot more attention than a PR headline ever will. This upgrade was rooted in real financial moves. Spirit's restructuring reduced its funded debt by approximately $1.4 billion and extended debt maturities well beyond 2025. The airline repaid existing debtor-in-possession financing, established a new revolving credit facility, and secured exit financing that collectively improved its immediate liquidity position. These actions created a balance sheet with more breathing room, something rating agencies could recognize in their credit assessments. An upgrade from D to CCC+ is not a sign that the company is suddenly safe. Far from it. Spirit still faced and faces operational challenges and ongoing market pressures in the ratings. Agencies didn't pretend otherwise. SNP itself cautioned that while the upgraded rating reflected improved capital structure and liquidity, material risks remained, particularly given Spirit's historical losses and weak free cash flow in the years leading up to bankruptcy. But think about what that upgrade actually means in practical terms. Lenders, suppliers, and institutional investors see a higher rating and adjust their risk expectations. Lower ratings typically force companies to pay higher interest rates or restrict access to financing. And in Spirit's case, every dollar of financing mattered as it executed its operational turnaround. The upgrade represented confidence, not blind optimism, that Spirit's financial adjustments gave it the runway to execute on its business plan. It's also important to understand that credit ratings aren't static. Later in 2025, Spirit's ratings again shifted as market conditions and performance evolved. Some agencies, like Fitch and Moody's, issued downgrades due to ongoing operational losses and liquidity concerns, reflecting continuous uncertainty about the airline's ability to stay aloft without further financial engineering. That dynamic, the market's real-time reassessment of Spirit's risk profile, is what makes the rating shift so compelling. It isn't a trophy. It's not a guarantee. It is instead a moment when the market acknowledged that a battered airline had structurally changed its financial position enough to command a measure of renewed confidence. That kind of recalibra. Sion, from default risk to speculative investment potential, is the essence of a comeback story written in the language of finance. When you look at Spirit Airlines' operational performance after its bankruptcy restructuring, what stands out is not just survival, it is measurable improvement in core execution metrics, specifically on-time performance. In 2025, while many expected Spirit to limp through its post-bankruptcy year struggling to keep flights running, the airline delivered something that really matters to passengers and markets alike: one of the highest rates of flights arriving on schedule among major U.S. carriers. According to aviation analytics firm Cirium, Spirit finished the year ranked third among the 10 largest North American airlines for on-time performance, ahead of many larger legacy carriers. That ranking represented a jump from sixth place in 2024 and underscores a notable improvement in operational discipline and execution. This on-time performance metric isn't a vanity statistic. In the airline industry, punctuality is a direct reflection of operational control, from crew scheduling and fleet utilization to turnaround times on the tarmac and maintenance reliability. For Spirit, which had previously been associated with delays and a reputation for schedule volatility, climbing into the top 3 demonstrates that the company tightened its operations in a way that real customers could feel. It means that even during a period of deep restructuring and capacity cuts, the airline was capable of running a disciplined network where flights landed within 15 minutes of their scheduled arrival time more consistently than most of its peers. This improvement was not accidental. Behind the scenes, Spirit made strategic choices about network design and capacity that focused flight schedules on routes and hubs where it could maximize reliability. By cutting lower demand segments and concentrating resources where they could be most effective, the airline reduced congestion in crew and aircraft rotations, a key driver of delays and cancellation risk. In operational terms, this meant Spirit optimized its network structure, fleet deployment, and crew pairing in ways that boosted predictability and execution. We also see supporting data from seasonal performance reports. During summer 2025, Spirit's on-time rankings surged ahead of legacy carriers, with the airline achieving a year-to-date operational reliability improvement compared to prior years. That summer performance reflects not only better planning but effective real-time operations management, even as the industry faced varying travel demand and weather challenges. Now, let's be candid. Spirit's improvements came alongside difficult decisions, including substantial cuts to capacity and workforce reductions designed to align its cost base with the new post-bankruptcy reality. But what matters for market perception and passenger trust is this: a reliable flight schedule. Customers care more about whether their flight lands on time than about bankruptcy filings or restructuring headlines. By delivering a top-tier on-time record in 2025, Spirit demonstrated that it can execute under pressure, maintain operational integrity, and provide a product that meets or exceeds industry benchmarks. In a turnaround scenario, operational execution like this isn't just good news. It's a critical foundation for rebuilding confidence among travelers, creditors, partners, and investors. It tells the world that Spirit isn't merely still flying after bankruptcy. It is flying with reliability that competitors take seriously. And that, in the brutal landscape of commercial aviation, is a tangible signal of resilience and potential future stability. When you talk about Spirit Airlines during this chapter of its story, you're not just talking about an airline that tripped and recovered. You're talking about a company wrestling with existential pressure while keeping its engines running and its flights in the air. After emerging from its first Chapter 11 restructuring in March 2025, Spirit faced a harsh truth: the measures that had gotten it through once weren't enough to secure long-term stability. Mounting losses, dwindling cash, and ongoing competitive headwinds forced it back into Chapter 11 protection for a second time in August 2025, a scenario few in the industry expected for a carrier of its size and visibility. But during this turbulent period, Spirit demonstrated a tenacious commitment to continuing operations and restructuring in real time rather than collapsing under pressure. Part of this resilience comes down to Spirit's ability to keep its day-to-day business running as it navigated deep financial stress. Even as it filed for bankruptcy again, the company affirmed that flights, ticket sales, reservations, and operations would continue without interruption, signaling to customers, employees, and markets that its airplanes would keep flying. That continuity under duress is a foundational element of the airline's surprise comeback. Markets and passengers don't forgive a company that simply stops serving its customers. Behind the scenes, Spirit has been actively securing financing to stay alive. In late 2025, it arranged for additional debtor-in-possession (DIP) financing of up to $475 million with court approval, giving the airline significant runway to finance daily operations, restructure leases, and shrink its cost base without grounding flights. Of that financing, about $200 million was immediately available upon approval, giving Spirit urgent liquidity to support operations under bankruptcy protection. That kind of lifeline, negotiated while under intense financial scrutiny, is not trivial. It's a signal that creditors and lessors still see value in keeping the airline flying rather than letting it collapse outright. In addition to large-scale DIP financing, Spirit also secured incremental emergency financing, a $100 million lifeline, through adjustments to its existing credit agreements. That additional liquidity came at a time when some analysts and competitors openly questioned whether the airline could sustain operations into the peak travel season. Yet Spirit kept assuring the marketplace that business as usual would continue and that its flights would operate normally. Spirit's restructuring journey also involves hard strategic choices that go beyond financing. The airline is renegotiating aircraft leases, rejecting unprofitable contracts, cutting routes, and shedding significant portions of its fleet and workforce to reduce operating costs. These moves, while painful, are part of a broader effort to right-size the business so it can survive and ultimately thrive. What you see in Spirit's second bankruptcy phase is not chaotic randomness. It's a controlled recalibration of a business under extreme stress. The company didn't quit. It didn't ground its network. It didn't walk away from its commitments to passengers. Instead, it used every available legal and financial tool to keep operating, restructure liabilities, negotiate with lessors and creditors, and secure the capital needed to remain in the air. That ability to stay functional amid restructuring, to fight for every mile of runway, and to continue serving customers even while reshaping itself fundamentally. That's the essence of Spirit's ongoing resilience and a key piece of how its story is evolving from bankruptcy headlines to a genuine comeback narrative. When you examine Spirit Airlines' vision for the future, the part of the turnaround story that really separates hope from a concrete business plan, you're looking at a company that has locked in a multi-year strategy aimed not only at clawing its way back from bankruptcy, but at returning to profitability on its own terms. Spirit's leadership has been transparent about the fact that 2025 and 2026 will still show substantial losses, with forecasts in regulatory filings estimating a net loss of about $804 million in 2025 and roughly $145 million in 2026 as part of the multi-phase transformation plan. But here's the heart of the matter. By 2027, Spirit expects to swing into a full-year profit, posting an estimated net income of around $219 million. Its first profitable year since 2019. That projection isn't pulled from thin air. It appears in Spirit's regulatory filings and represents the culmination of deliberate financial and operational changes designed to right-size the airline, reduce costs, and align capacity with demand in a volatile industry. To reach that profit target, Spirit is pursuing a range of deep and sometimes difficult actions. It is shrinking its network, reducing airline capacity by around 20% compared with 2025 levels, and reshaping its route map to focus on markets where it can achieve higher load factors and better unit economics. The business plan assumes a reduced network in 2026, followed by a return to growth starting in 2027, a clear signal that Spirit is positioning itself not just for survival, but for expansion. Once the transition is complete, asset sales and structural cost cuts play into the profitability plan too. Spirit is working to monetize non-core assets, including its headquarters, valuable takeoff and landing slots at LaGuardia Airport, and inventories of spare aircraft parts to generate liquidity and reduce fixed costs. These moves are painful in the short term, but are intended to strengthen the balance sheet and provide the runway necessary to reach positive earnings. ABOR restructuring is also a critical component of the strategy. By furloughing pilots and flight attendants, adjusting staffing levels to match the right-size network, and negotiating new cost structures with unions and employees, Spirit aims to reduce its labor cost base significantly. The airline has estimated that such workforce adjustments could save hundreds of millions each year, freeing up capital that can be invested in operational efficiencies and customer-focused improvements. Behind all of this is a disciplined focus on EBITDA, earnings before interest, taxes, depreciation, amortization, and rent, with a target of about $900 million by the end of 2027. For an airline that has struggled with losses and debt, achieving robust EBITDA figures is critical. It reflects core operational strength and indicates whether the business can generate performance cash flows strong enough to cover costs and service debt. Honestly, this all adds up to a turnaround plan that accepts reality without surrendering ambition. Spirit isn't promising short-term miracles. It is laying out a measured, data-driven timeline for returning to profitability, grounded in capacity discipline, asset monetization, cost restructuring, and a clear pathway for growth after 2026. The real question for observers and stakeholders now isn't whether Spirit hopes to be profitable in 2027. It's whether it can execute all the elements of this ambitious transformation at the speed and scale required to deliver on those projections. Spirit Airlines has stared into the abyss, battled crushing debt, navigated not one but two bankruptcies, and faced doubt at every turn. And yet, against all odds, it has not only survived, it has emerged stronger, leaner, and more relentless than ever before. The skies that once seemed impossible to conquer are now its proving ground. So here's the truth. This isn't just a story about planes and profits. This is a story about vision, grit, and defying the impossible. Spirit Airlines has shown the world that comebacks aren't given. They are earned with bold moves, fearless decisions, and unwavering focus. And as Spirit charts its path to profitability and industry dominance, one thing is crystal clear. The sky is no longer the limit, it's just the beginning. The question now is, Are you ready to watch the rise of a legend in real time?